Hello, everybody, and happy December 2nd. James and I are back with another information-packed session. Today, we're going to be talking about bonuses, gifts, and benefits. Oh my. And so we thought it was pretty timely with for you guys as your clients are, starting to talk about giving out bonuses or having, I guess, virtual parties. So we'll see if virtual Christmas parties apply here, James. But I just wanted to introduce you to our presenter today, of course, James Rhodes from Taxation Lawyers. James, if you could advance the slide. Oh, look at that fancy effect there. So James operates a boutique taxation firm in Ontario. You can read the rest of his bio there. He's super smart, okay? So just, and has lots of education behind him. He also has a fantastic LinkedIn group called Canadian Taxation Professionals, and it's packed full of other really smart taxation people, whether they're CPAs or lawyers. And so it's been interesting to get involved in that group as well. We would love to have you join us. And of course, don't forget about Sage's own group, Canadian Sage Advocates, on Facebook. We would love to have you join there as well. James, this is, I mean, we were together for Sage sessions, right? Our virtual sessions back in the spring. And then we had another webinar like this in October. So this is probably like the 5th one we've done together, or?
Seems like forever.
Too many, yeah, too many. Anyway.
Not enough, not enough. I really enjoy these. I hope everybody actually likes them too. Because I never remember at the end, because I'm so tired of talking. I always want to thank Sage, because Sage set this up and they do this for free, and I love it. I love the exposure. I love talking. I love Rachel in a friendly way. Hugs.
I love the questions that come in from our bookkeepers and accountant partners who have clients that are dealing with this day in and day out. So actually, Brenda Alexander just said, you and James are an awesome team. Thank you so much, Brenda. That's so sweet. So if you could just advance the slide one more. Again, getting started with the bonuses, gifts, and benefits. We're going to be talking about having a discussion on employer benefits, gift giving, and even better, gift receiving, employer provided parties, and also employees who are also shareholders. So I will let you take it away, James. As usual, I'm going to keep my eye on the questions pane, guys. So if you do have any questions or comments, please feel free to ask those questions throughout. I will cut James off if I need to ask some of these questions if we happen to have time at the end, and I will try to make sure that we do have a bit of a buffer there as well, which means no story times, James.
Lots of story times.
Then we'll try to get to as many questions as possible there as well. Okay, take it away, James.
All right, lots of story times. Just going to say that. So what I want to talk about is basically is a tax lawyer, right? I go in and people will bring me in audits to deal with CRA. And I also do, the majority of my work is objections, where after CRA's come in and looked at something an employer's done, they don't like it. And so I see all the problems, and I'm just sort of, the idea of these presentations is to give you my alarm bells, all the things that I see that like, oh, I wouldn't have done that, and all the problems. So, and as I was preparing for this, I thought, I love CRA. I have friends in CRA. I know the director of the local TSO. He's a great guy. When he retires, I'd love to hire him. And I have ex-CRA collections officers that work for me to deal with CRA collections. So, but when I make the jokes, it's like they're my best friends. So whenever I make jokes, don't think anything bad. It's just best friends joshing around. So with that being said, I'm going to talk about employer benefits. Why are they taxable? Gift giving, and obviously the even better part of receiving. Employer provided parties, and when you have I see them a lot out here. Owner managers who are shareholders and employees who give themselves gifts. So, and what I want to distinguish is, out of all this talk, I'm not talking about allowances or reimbursements. I know some people give Christmas allowances, and sometimes they reimburse expenses for different things. You're seeing it now for the workspace and home, where If your employer is giving you an allowance for your workspace and home, it's taxable, but not necessarily deductible. But if they're reimbursing you and CRA is giving an administrative concession up to $500, it's not taxable. So I'm staying away from that. We did another seminar on that, and we should probably do more because it's so much fun. So I've written down these resources. T40130 is actually the best resource for you to look at. Every employer in the payroll department should be looking at it, every bookkeeper, just so when you read it and then you're doing your client's taxes or you're doing the expenses, you're like, your alarm bells go off saying, ooh, wait a minute, there's something going on. So, and the thing that it happens a lot is the HST implications on taxable benefits. I'm going to talk about it at the end, but everyone thinks there isn't, and there is. You are actually, when you give a gift, you're actually deemed to have sold it to the employee and collected HST. So yeah, always have to remember that. So starting on, why are gifts taxable? Well, because the CRA never gives anything away unless it's notices of reassessment. So what we're looking at is 6 sub 1 sub A of the income tax, right? And the thing that you have to be aware of, it makes everything that your employer gives you, good or bad, taxable benefit. There's obviously a caveat to that. I know someone's alarm bell went off and said, oh, no, there is distinctions here. So in looking at 6.1a, so I'm just going to move that window. This is, there shall be included in computing the income, almost anything. You got it by reason of your employment. So that means Christmas parties, right? You're only there because you're generally related to the person or who's an employee or your employee. You don't get a lot of Christmas party crashers, which is probably a good sequel to a movie. But and it's the value of benefits. And the thing that catches everyone, right, is and other benefits of any kind, whatever. So the income tax, the CRA and the tax court are all on the same page that of any kind, whatever is unconstrained. Anything conceivable falls in there. There's no predefined definition. It's almost anything. And so you have to think about received, right? Received or enjoyed. So they got something and they didn't enjoy it. That's too bad, right? The idea of enjoyed is you didn't really take away anything tangible. It's an intangible benefit. So that's why this section 6.1a is designed to catch almost everything an employer gives to you. And remember, by the taxpayer or by a person who does not deal at arm's length with the taxpayer. So that's when, your spouse comes to the Christmas party, wins the cruise, and you're thinking, why is it a taxable benefit? She doesn't work here. It's still a taxable benefit to you who was the employee. So first rule of thumb is, did the employer give something to the employee or their family, right? So this is, I tell you this to just be simplistic. When you're doing your accounting and bookkeeping, or you're going through the employer's payroll, everything the employer gets, did they get something? You've got to take a look at whether it's taxable. Did they do something for the employee or the family? Christmas work parties is the biggest and easiest example, right? So, and you must start, like a lot of times people say, well, why is it taxable? No, start with it is taxable and figure out why it's not taxable. That's the number one mistake, where everyone just thinks, like, how could this possibly be taxable? And then I explain 6.1a of them means, well, if they got it and they didn't enjoy it, they still got a taxable benefit, right? So, because I actually started off number 1 and 2 saying if they got something nice, because I was trying to be funny, but I realized if a gift sucks, it's still a taxable benefit. Story time. But I want to tell you, when I was working for an accounting firm, one of the large ones, our Christmas bonus one year was they made a donation in all of our names. Fabulous. Like I understand giving to charities, and my speaker fees, sometimes I donate to charities of cause. But I was like, okay, we're the joke was he sat around and figured out, is this a taxable benefit to us that they made a donation to a charity and claimed that they made that charity donation in our names, but yet got the charitable tax credit for it? I say that as a joke just to say, no, that's not taxable, because the ultimate idea of a taxable benefit is, this is the theory behind the income tax, is that there's an economic result that occurs to the employee. So ultimately, when you look at it, you're looking for the economic result. And I'll have to, I put the case of the golf club membership, which is called Radlowski, but I'll speak about that in a little bit. Put that too early on my slide. So the second rule of thumb is, if an employee gets something and somebody said it's not taxable, that is generally only by reason of administrative concession by CRA. This is where you're going back to T4130 to say, what does CRA let the employee get tax-free? Now, and I say that, I mean, there are subparagraphs to 6 sub 1A that make different things non-taxable, like a health spending account. But this is the idea: is if you've given them a free cruise at the Christmas party, is it non-taxable? Well, you start with the yes, and then you look to see if there's any administrative concessions that makes it not taxable. So that's my main point. And then I say, people say why? And well, I was like, first, as an employer, if you fail to do the right source deductions, you're looking at penalties. The big one I see is mad employees. I was dealing with an employer who they were on the down low fighting over taxable parking benefits with CRA, and then the case came out and they were completely wrong, and the employees were like up in revolt. I mean, they got free parking, but they were mad that they had to pay tax on it, and it was a bigger fight about the mad employees than it was actually with CRA in some aspects. So, and then you got the issue of if it's a taxable benefit and they're unionized, is it a pensionable contribution that you have to make? So, plus the interest that because the employee gets reassessed for this taxable benefit, and CRA might be going back 3 years. I mean, it's not just the taxable benefit; it's the interest for 3 years. And so, these are the considerations why employers really have to take it seriously. And I find sometimes they're a little too cavalier about it. Lovely. That is my fire alarm.
I mean, I knew that this was a hot topic, but I mean, come on.
Yeah, the hot topic.
Since we actually have had a couple of questions come in already.
Yeah. What's going on? No, it's all right. All right, we'll just continue on the basis. We just had a new fire panel, but
based on one of the
wow.
examples that you actually just gave, James, Diane is asking, what if an employee is related to the business owner? Can you still give a gift to that employee?
So this is where I draw a distinction on that. It starts being taxable, right? Because the owner is either a shareholder or an employee, right? And then you've got to ask, why are they getting this gift? If it's out of the blue, then yes, it's taxable. And I'll talk about, is it taxable under 56 or is it taxable under 61A? But it starts out being taxable. Now, if they're related and they are, say, a person that refers a lot of work and you're giving out gifts to the people that refer you work, then it's fine. But you just got to figure out, you start with the yes, it's taxable, 61A or 56 sub 2, and then you decide, okay, this is reason why it's not taxable. I'm not giving it to just them in the year. I gave it to everyone that gave me over, $10,000 of work. Does that make sense? Okay.
Yep.
Good. And the fire, I hear the fire's over, so.
Oh, wonderful.
I was like, oh no, what do we do? Do this? I'll take the webcam with me as I walk outside. So third rule of thumb, obviously what the CRA giveth, they taketh away. And, I think this is the problem with watching Lord of the Rings too much. You start talking like Middle Earth. So, and I say this jokingly, but it really is. Remember, if you all remember, the store discounts to employees, where CRA announced that the employer could not give a store discount to, I think it was retail employees, from the value that the general public pays. They had been doing it in the past and it was a non-taxable benefit. CRA decided, no, we're taking that away administratively. And then there was this huge uproar and every single paper talked about it like it was a crazy thing. And I'm like, that's really what 61A says. But, because of all that, CRA backed down and reconsidered its position and decided in its wisdom to make it non-taxable. So, and if you're really old like me, credit card reward programs, they used to go and audit employers, take a look at the credit cards they're using, saying, hey, what do you spend your points on? I have a client that because of how much gets spent on their credit card points, each employee, I think every 3 years gets a free trip somewhere. So now it's a free Zoominar. So, and I put down just as, so you see CRA now, this is where the back down, right? If you sell the merchandise to your employee at a discount, the benefit they get from this is not usually considered a taxable benefit. Okay, right? That's just administrative concession. But and maybe that's if you don't get administrative concession, this is where CRA has come out and said something that only applies to this and everybody else it doesn't apply to, right? So I wanted to put that out because that actually they said no, and then they decided to change their opinion, and then officially when they put it in their T14130, you know it's an administrative concession that you can rely on. If the auditor ever comes in and says, hey, listen, it's a taxable benefit to your employees, you're selling this stuff at a discount, you'd be showing them that rule.
Yeah, so I always had the T4130 either bookmarked or before I had it bookmarked, when I was a little more paperful than I became, then I would actually print it out and have like a copy, because those kinds of questions came up all the time, especially this time of year, right?
Yep. So next slide. So again, CRA administrative concessions, right? T4130, as I call everything you get that we don't is taxable. So that's not its official name, but that's what I like to refer to it as the what can you get away with Bible. So again, if you are working, if you're the employer's payroll staff, you review it. It's really, really good, actually, comprehensive document to create your alarm bells. So holiday presents, right? The CRA's breakdown. A gift, so if you say things like it's a gift, they have an administrative concession on it, but you've got to meet what they say is a gift, right? For special cases such as a religious holiday, a birthday, a wedding, or the birth of a child. So, hey, happy Monday, here is a new laptop. Doesn't work, right? It's got to be, hey, Merry Christmas, I want to give you all a present. So, an award is something that's for outstanding service or employee suggestions. It's not really related to their employee conduct, and that's the main point I want you to take away for, right? No recognition of job performance, because if it is, it's not an award, it's a reward, and rewards are taxable benefits, always. So basically, if the employee is doing good and you want to thank them for that, it's a taxable benefit, and that is because that is really like salary, right? I mean, hey, listen, you did fantastic this year. I'm not going to give you any more, but I'm going to give you a car, right? It's the games that people are playing to reward and try and say it's a non-taxable benefit. So CRA has put the lockdown on what a gift is and an award is. So if you are trying to fall into those administrative concessions, make sure it qualifies for that.
Where would you think years of service items come in? Award? Okay.
Yeah, so it's not in here. I think we talk about it later on, but it's it's years of service as an award.
Thanks. That came up as a question, by the way. I wasn't just curious.
It's okay to be curious.
Okay.
So got something or enjoyed something from employer, right? First question, is it cash or near cash equivalent? Cash, obviously very easy. Near cash, what is near cash? Well, gift cards, right? Gift cards, CRAs, it's a taxable benefit no matter the amount, right? And you say, why do you ask that? Well, you're shooting for the administrative concession of $500, and you want to give your employees something. If you give it to them cash, great. They'll be like, why did I just, if they're in the 50% bracket, they just paid $250 on it. So obviously you want to try and shoot for a non-taxable benefit, right? So what is near cash? This is my first, I always shake my head at this near cash stuff, but so, gold bullion, I use that as an example, but gifts or cards, certificates, right? You can go in, you can buy anything you want, gold bullion. So why taxable, right? And they say in gift cards, why is it taxable? Because it allows the employee's choice of purchase. So you could go in the LCBO, buy your employee a big bottle of liquor, and it's a non-taxable benefit. But if you go and give them a gift card to the LCBO, it's a taxable benefit. So I say, welcome to the gymnastic class, because I was just like, what's the difference between me walking in there, buying it, and they walk in and buy it? And I do that because sometimes they're really busy. I'm like, hey, I really want to thank you. Why don't we figure out what your presents are? I'm smart enough to know through all the relationships I've had in my life that I am a terrible gift giver. And I have learned that the best gift is me asking them what they would like and then letting we buy that together.
Buying it for them, yeah.
I don't know, I say this because I sometimes make men jokes, but that's a man thing, right? Where it's like, I am wise enough to know, please, what would you like, rather than trying to think what is a good gift, because I'm not that good. I would give everyone the Income Tax Act. It's a wonderful book.
No, thanks.
Props up computers. It's a good, bedtime reading. So, and this is the gymnastics class, right? It's if the employer can choose which movie that to see and when to see it, then it is a taxable benefit. And I was like, well, what if I give them a 1-year pass? It's not a gift certificate. It's I've bought a collection of one movie for every month for the rest of the month. They get to choose their movies technically, right? So is that a taxable benefit? Is that near cash and a taxable benefit or not a benefit? And that's why I say the gymnastics class, because you're like sitting there thinking, well, what is that? And I say it's non-cash because they can't convert it to anything else. They can only watch movies. So welcome to the movies.
So even though they may have their choice of movies, I just want to get specific on what choice means, right? They may have their choice of movies, but they don't have their choice of anything but a movie.
Yes, I use that example because, and there's no, I don't have an, I don't say, hey, this is, you're doing the according to James ruling here. Until it gets to the tax court, it means nothing. So if you gave them a gift card to a movie theater, they can go out and go to the arcade or buy popcorn or not go to the movies. If I gave them passes to a movie for, like, you've got pre-purchased movies for the rest of the year, to me, that's like, okay, they have no choice. They have to see a movie. I'm following within what CRA's example is, which is they can't do anything but see a movie. I don't think I think it would be ludicrous to say, I'm buying you a pass to this movie, to this, every Marvel movie for every month for the rest of 2021, I'm buying you, a movie pass for. That obviously would be non-cash, right? But it's that, what if I give them passes where they can pick the movie in the year, but they can't spend it on anything else? To me, I say it's not near cash because they can't do anything else with it. So, but again, this is according to Rhodes. TM. So when you're doing this, this is actually a really big issue, right? Valuation. Siri, you've got to, when you figure out that they're getting something, you've got to figure out what the value is. And because you're looking for the administrative cap, right? You go over $500, the over part is taxable. You're under $500, no taxable. So in a lot of times the fair market value, the valuation is very easy, right? It's the valuation is fair market value of the benefit, and most of the times it's what your employer has paid for it. If they buy it in bulk, generally it gets cheaper. So it's not one of these issues where your employer might get a better discount on than the fair market value, and you've got to watch for that. But most times CRA says what the employer paid for it is obviously the fair market value because that's what someone bought it. It's rare that you get some insane discount. So but there are cases out there, and they're very important for when valuation is not what the employer paid for it. So, the first caveat to this is where I was talking about, it's that case of the golf membership. I think it's called Redlusky, where the employer gave him a membership to a golf course because the employer got 90% of their business basically from the golf course. And it was very important for his sales manager to be in that golf course. And he's like, I hate golf. To be honest, I despise. I would have never gone, but for my employer saying, here's your membership, you must go or else. So when he went to CRA, he said, well, it's a membership. We don't get free memberships. Obviously, it's a taxable benefit. Then they went all the way to tax court. And after hearing how much this guy loathed to golf and didn't golf, he just would go and mingle. They said, where the benefit is primarily enjoyed by the employer and it's incidental to the employee, it's non-taxable. And there was a federal court of appeals case that just changed that, and actually we're waiting to see what happens with that case. Incidental was this, right? Very, very minor. But that case almost said it doesn't even matter. It doesn't even matter if it's minor. If it's $1, it could still be a taxable benefit. And everyone's thinking, okay, that doesn't seem right. That's not within the scope of 6.1a, which is there's always been this caveat that if your employer gives you something as primarily the benefit to the employer and really incidental to you, that there's no taxable benefit. So I raised that to say, if that's an occurrence, just make sure you document it, take that documentation and get your laminator out, because when you get audited, CRA will for sure say that this is a benefit to the employee and it's taxable, and you'll be having to show why it was actually done by the employer at the employer's behalf and how it benefited the employer. So for instance, in the the golf case, here's the list of our clients that we got from the golf course. Here's how much revenue we generate from golf course clients. I mean, it's the who's who of people for our business. So, and remember that fair market value, while it doesn't mean necessarily what the employer pays, it does include HST and provincial taxes. So, and now it's story time. Can we, maybe for the next seminar, we can get some kind of sprinkly thing that comes down on my screen when it's story time.
I feel like we need like a sound effect, like, you know, like when you were little and you played the little 45s. Okay, so now I'm aging myself, and it was like, this is now the page, and there's this blinking sound.
So, and I say this because it's a good story. I actually had a client, his employer had gotten him a camera, and I think it was $600 with Molnota or something like that. And there was they actually gave, it was actually part of the employer's, I think, award package for long-time service. And so there was a bunch of guys that got these cameras. And so I ended up doing it just for fun and for free for them because it was such a small matter, but they were asking me questions. I was like, let me help you on this, because what had happened was the employer paid $600 for it, but he's like, the employer got taken. These cameras aren't $600. They had a company that supplies all the gifts to the company, you know, from cameras to pens to really awesome water bottles at a markup. And he's like, and he was showing me the listings. I can get this camera for $400 with tax. It's under $500. He goes, this isn't a taxable benefit. I'm like, you're right. But CRA was stuck on the fact that the employer paid $600 or whatever it was for it. And so we were cutting out, you know, like we went through different magazines to cut out flyers to cut out the pricing on it to show the CRA, listen, this is fair market value. We went all the way to tax court, and it's fine. When the DOJ lawyer got it, he's like, yeah, you're right. I totally get that the fair market value is actually what he would have had to pay for it if he went to the store. And so, thank you. I think we almost went as far to, we went to MB Black's camera and we had a quote. We got them to make a quote. So I say that because what the employer pays isn't necessarily always what the fair market value is. And so just be aware of that. So valuable of tangible items, right? So CRA's administrative concession, the total value is $500 or annual. It can give you as many pens as they want. I shouldn't use pens because that's probably a trivial value item, but they can give you enough water bottles that they add up to $500. And I do love this water bottle. That's why I keep playing with it.
No, it's because I don't have one and you're rubbing it in my face and I want one. And
almost no one has this. This is a lark.
That is a commodity.
It is. It for those who don't know what larks are, it's got a UV light in here that sanitizes the water. So when a zombie apocalypse happens, I will have fresh water. So if you're over $500, everything over $500 is taxable, right? Trivial small items you just ignore. You know, series example, right? They had coffee or tea in there. I'm like, okay. Signed autograph of James Rhodes. Someone put my staff put that in there, but I think that those autographs are going to go somewhere someday. So this is an important case I want you to know about. It's called the Gold Ring case, Gerald Whistler. One ring to bind all employees. So this is your example about service, years of service. So he was given this gold ring for 15 years of service. It was valued at $562. And I should say that the series administrative concession, I didn't go back and check it, but I'm old enough that it strikes me that it changed. It used to be that if you went over $500, the entire thing was taxable. Now it's if you go over $500, the incremental over $500 is taxable. And obviously that's because that just meant that every employer scrambled to give a gift that was $499.99 plus tax, including tax, right? So it was stamped with the employer's logo. He went and fought it, saying CRA is like, it's a taxable benefit. And this is rare where you get these people who's like, no, I will not do this. And he went all the way to the court by himself. And he brought an evaluation by Burke's Corporate Sales. And the joke with Burke's Corporate Sales is you don't walk into Burke's and say, can I speak to a corporate appraiser, please, a corporate salesperson? That the employer who bought all these rings from Burke's and then probably took them to somebody to get them stamped with their logo. This guy decided to fight, and his employer's like, absolutely, let's do this. Let's fight this. and they got an appraisal. It was worth $76 because the ring had a huge stamp on it as to, the employer. So the court went to it, and basically the court looked at it and said, yeah, you're right, this ring is ugly. I wouldn't pay $562 for it. It's not a nice clean ring. It's got a big logo stamp right across. And so you might say, oh, what's this? I actually had a client. They gave their employers for service awards very expensive watches. We're talking a couple $1,000s, and they stamped them. They stamped them with their logo all over it, in the back, in the bands. So is it worth a couple $1,000s anymore? No, because no one will. You can't go on eBay and buy. Say, hey, by the way, I forgot to mention that the back has this my former employer's name on it. So you just have to be aware that sometimes when you're logalizing your gifts, be aware that you can be affecting the fair market value negatively and bringing it down below $500. Is that a Rhodes?
That's a great way to take a taxable gift and make it not taxable. It's to stick an ugly logo on it.
That's the rules. So this is the one I love, and I jump all over it because, when I was, and it's story time, when I was at the Department of Justice, we have what's called CRA litigation officers, and sometimes we like them, sometimes we don't. We deal with them all day. They're basically the people that instruct the Department of Justice on the tax cases. They will decide if they can settle or not settle outside of the Department of Justice protocol. So we were having a Christmas party for them one year, and I remember, there's no budget for it. My boss came around and said, I want everyone to kick in money because we're going to buy alcohol for these people. I'm like, these are the people that make my life sometimes difficult. When I want to settle a case, they make me write a 5-page memo instead of saying, yeah, Rhodes, you're right. I'm not buying them alcohol.
These are my reasons to drink, right?
They make me drink. And nonetheless, we all sucked it up and bought the CRA alcohol because maybe it'd make life easier. And then we all sat around a table looking at each other, drinking our own alcohol, looking at them. So under $150 per person is, and I remember this per person, I got a big comment about it later on, but per person considered not a taxable benefit, right? And this is exclusive of additional costs. That's a party cost, getting them home safely, taxi fare, overnight accommodation is not included and can still be considered a non-taxable benefit. Anything over $150 a person is actually, the entire amount is taxable. And so this is where I think they did the old administrative thing where if you go over $150, it's all taxable because somehow CRA wants your party to be only $150 or cheaper because that's the way parties always work out, right? But apparently this is fire alarm testing day. So how do you value a party? And I put this as a CRA IT, and I jumped all over it when it came out because I was like, don't let people who don't plan parties make this policy, and because it's clearly a made-up policy. So CRA in this policy says, if the employee doesn't intend, there's no taxable benefit. Really? Okay, thanks for that one. Two, but they say the per person. How do you calculate the per person? The per person is based on attended, not invited. So you're thinking, listen, I've got 100 employees. I'm going to buy something at $100. It's roughly $100 an employee because that's what Rhodes said it's 150. So we'll just do 100 because with tax, it's going to come to 113 plus little incentives and stuff like that. So it's all good, right? And then you have a blizzard and only 5 employees who have snowmobiles come into the party. What happens? According to the CRA's position, it's attended. If the 5 people show up, for the party that cost $10,000, each employee got a taxable benefit of $2,000. And I don't even understand that. I just think that they're just being silly because a lot of times in the income tax, when you're doing a valuation technique, it's based on the party that's invited and not what actually happens, right? Perspective versus reality. So this is what I say as an employer, you must keep a list of the attended and the invited. And it sounds so strange because most Christmas parties I've been to, the employer is not figuring out who shows up, but actually figuring out, walking around, greeting one, having a good time, because people cancel last minute, things go on. But CRA's policy is no, keep a list of attended because that actually can figure out what your taxable benefit is. So this is a Rhodes thing, right? When I fight this, because I've done a fight on this, The ultimate theory behind 61A, again, is economic benefit. I know the employees got to eat as many roast beef dinners they wanted that night. And then, because I'm old, do you remember, if you remember breakdancing, we used to have big pieces of cardboard that we'd carry around to parties with us, and we'd spin around on it. And yes, I did breakdance. And I was like, okay, so you've got a huge dance floor and you're full of roast beef. Why wouldn't you be a great party? But is it worth $2,000 is the question. So the takeaway from this is keep a list of attended and invited, because you might get into a fight on it. So what does it mean to the employer in terms of deduction? So usually when it comes to food, drink, entertainment, right? Subsection 67.1 sub 1 applies, which is only 50% of food and drink is deductible to employer. And that's absent one of the exceptions applying. There's a bunch of exceptions. Like, I think if you're a restaurant and your normal course is giving out food, and you're giving out food to people that just say, hey, you really like I really want you to come to my restaurant, here's some free meals, you get to write that off 100%. But you got to fall within the exception. 67.1 sub 2 sub F, right, is the exception when it comes to holiday parties. So first test, it's got to be, you got to have 6 or fewer special events in the calendar year. And so remember, it's calendar year, not fiscal year, which is, don't be going off your corporate fiscal year, which is if it's not calendar. So like, hey, it's our corporate year ends January 31st. Let's have 4 parties in, January 1st. And then we'll have 1 next year. It's like, nope, that's, or 3 next year. That's actually, you're over 6 in the calendar year. So it's the first thing to be aware of. 2, generally available to all employees employed by the person. This means there's been a couple of releases by CRA about segregating. Is it okay to segregate parties out? And the theory with CRA is, as long as you're segregating the employees and not saying you can't come to certain groups, like, hey, listen, it's a party for office staff, that's great. And there's an office for the warehouse staff, that's great. And maybe it's like the office where the where the warehouse staff and the office staff just don't get along, unless it's basketball over with Michael Scott. So so that's the second thing. And the third thing, at a particular place of business. So your employer doesn't have to have everyone gather in one locale. If there's a basis for your employer has different work locations, they can have different parties at different locations. And so you're into 2 criteria, right? Different places of business for the different parties, and maybe an argument as to why different staff are going to different parties.
Okay, we have a couple of questions that I think might belong right around here. So Suresh is asking about, what about things like recurring benefits, like free pizza every month end? Now, would that fall into the 6 or less? And so would it be best to have quarterly pizza parties as opposed to, or like bi-monthly, if you don't like, and then make your December one a holiday party, right? Like, how do we?
So there's 2 questions in there, right? The first question, is it a taxable benefit to the employees? And the second question is, does the employer get to deduct 100%? Those are 2 distinct questions. So I would say that the first question is, does it fall under with 61A? Yes, it can actually fall under 61A, that it's a benefit they're enjoyed. Out here in Kitchener, the home of tech, right? I remember where I used to have my offices, they would hey, every night, what do you guys want? What do you guys want? They'd be going out and running around giving them orders of food. And I used to think, this is crazy, because literally these, as I call them, the kids, because I'm a little old, they were having scooters going around. I'm like, you're bugging me. Like some old man, get away with your scooters, tech kids. But it was every night. And I'm like, and they were not looking to see who stayed and who didn't stay for the taxable benefits. And I was just like, there's a storm here. I mean, I know you're on financing right now, and so it's great, and you can buy whatever you want, but at some point, if CRA audits, you're gonna have a problem. So in terms of taxable benefit, I really think you might have a problem that they're receiving a taxable benefits. Do you report it because it's trivial? That's a different question. The second thing is, does the employer get a deduction for it? And so in your case, special events is the key that you're not triggering in my mind, which is, it's not true. Are these meetings special or not? If you're just having them because you're having them, then they're not special. And this paragraph F doesn't apply, and it's a only a 50% deduction for the employer. And I got to say, this is me as a DOJ lawyer, and I've done this a long time. That's an audit. That's just an audit alarm bell, right? If you are ever going to be audited, they're going to look at all these pizza purchases and go, what's going on? I mean, someone loves pizza this place. And, okay, this is for the employees. It's team building. We're having a meeting. It's of trivial nature, but if you're deducting 100%, I think that'll be wrong. You need to be following with this example.
Got it. I'm also getting several questions, and for attendees who aren't getting your questions answered immediately, it's because you either have the same question as many other people, and so we're going to follow up like this, or it's because it's in content that I know is coming. So please be patient while we get through the rest of your content to see if your question is going to be answered. But one that I'm seeing a lot of, James, is, we can't have a party this year, so we want to send out something, whether it's a restaurant gift certificate or something like that. Can we still use the party rules because this thing that we're giving them is in place of a party? So how would you address that? I mean, it's kind of a unique year, but for me, so I'm going to give my opinion. The Rachel version is, but it's not a party, right? So we can't say it's something that it's not, but I'd love to hear your take on that, James.
This is where you didn't get it from me. You didn't hear it from me. I think, so the problem with auditing is always it's 3 years later, a vaccine's out and everyone's like, COVID who? Because now it's SARS 10.0 or something that's everybody's thinking about. So 3 years later, is CRA going to remember the conditions that were going on? So first, you want to create some policy about this, laminated to make sure that when the employees you're getting audited and they turn around to the employee, that there's a reason for it. I do think that there should be some administrative concessions by CRA on this to say, yes, obviously we can't have holiday parties. We've got a holiday party administrative concession. So as long as the cost to the employee, to each of your employees is $150 and you're treating them all equal, I feel like that administrative concession should bend by CRA. But this is the problem with administrative concessions. If they don't bend, then what do you have? You have a taxable benefit to each of your employees. I mean, I think in my interpretation, it makes sense to say this, what you want to do falls within the exception. So I feel like you wouldn't be negligent in doing it. And therefore, if the CRA audits, outside the normal reassessment period, it's a too bad, so sad, right? You show them this Sage webinar where I was saying, I think that CRA's got to bend a lot on things, right? They bent on giving, an employer can give an employee $500 to allow them to buy something to have a work, for their home office. That's a completely new administrative concession that was a complete bend on their normal rules that you can't buy anything for the employees or as a taxable benefit. So I feel like what you're asking makes sense to me, and I feel comfortable saying that to me, the administrative concession in the year of COVID-19, that makes sense. But I obviously can't, 3 years from now, audit CRA might have no humor and say that Rhodes is an idiot.
Who knows?
So, yeah. Who would say that, right? So, okay, is that good?
Yeah, let's keep moving.
Keep moving.
Who's invited is where we start.
Who's invited? So
not
just remember.
CRA. No.
I would totally invite CRA. That'd be fun. We talk about tax and stuff. That'd be the coolest party ever. So remember that that employee party is for employees. If you start inviting clients, there was an actual case on this that the CRA came in and said, listen, you didn't meet the definition of paragraph 6.1F. If you could show us that there was a table for employees and only the employees ate at that table, great, but you can't. The employees and the clients all mingled and they all partook of the festivities. Therefore, paragraph F did not apply and the employer lost the 50% deduction. So anniversary long service non-cash awards, right? This is what we're going back to the start. It's $500, but it's got to be based on something, not how they performance. It's based on something, just the last person standing at your office. Congratulations, you've won an award for being here the longest and never leaving. And again, you want to make sure that it's a non-cash item. You don't want to be giving them a cash benefit. a cash gift, sorry. Shareholder benefits. This is where you're seeing, I see it a lot, right? The owner manager's in there, they're giving away, they're buying all these nice gifts for people, and it's like I have one where they literally gave away maybe $15,000 of gifts, and so and I want to state something actually. I think I forgot to state it, and it might be later in my slide. I just can't remember where to put it is, but it's important. So what happens in an audit? CRA comes out, looks at the employer, and sees, oh, I see all these gift cards. And then your response is, well, we gave those gift cards as to the employees. And CRA says, well, did you put it in their T4 because it's a cash gift or a near cash gift? And you're like, oh, I forgot. I didn't realize it. I didn't read T41030. Hey, I hadn't met Rhodes yet. So CRA is like, okay, but you know what? Because you didn't put it in their T4, we're not giving you a deduction for anything. And I've been in audits, and I'd say 8 out of 10 audits, this is the CRA starting position before I get involved, is no deduction because you, no soup for you, because you didn't put it in their T4. And so then I say, okay, please show me in the act where that section applies, that the employer doesn't get a deduction for something they incurred for business, giving things to your employees as a business expense. 18, nothing in section 18 stops it from being deducted. So where do you get this rule that if you didn't put it in the T4, it's not deductible? And then they're like, yeah, you're right. There is a penalty that can be applied, a source deduction penalty, for failing to deduct proper EI and CPP on the benefits. But if your employees are already met their maximum, right? So they're already over the maximum, any benefit you give them has no EI, CPP repercussion. So it was really just not source deductions taking off that deduction. So what's the penalty? It's not really that big. But that's the problem. CRA comes in and says, no. And you have to fight back at them. So what always happens too, so I had this employees giving away $15,000, tons of gift cards. They gave away the employee that won, they had a lottery system or a game, and the employee that won got a cruise. I think it was worth $5,000. Great. But CRA is like, okay, where's the list of these employees? And it's 3 years ago. I don't know. You have to keep a list of the gifts that you give out if they're over $150, because CRA, you've got to put it on their T4. You do run the risk of fighting CRA, which is never fun, where they say no deduction because you can't tell us who got it. Because they don't want to sit there and let it slide, right? They don't want to, well, if the employee didn't put it in the T4, then you're not getting a deduction for it, is usually what I'm always seeing that fight. So when you have the owner manager who's also there, they're giving away stuff, the owner manager wins a gift card, they're, oh yeah, I want a gift card that I bought, an hour ago. What is that? Is that, I should say, a gift card, a pass to a Marvel movie for all of 221. Every Marvel movie that comes out, I will give you get a free movie too. So did they get it as shareholder? Did they get it as employee? You've got to watch that out, because CRA has a very narrow view of shareholders, like owner managers, that because they think that you can always be tipping the scales, right? Hey, I magically won the cruise for $5,000. That had only had my name in there. So if they get something as a shareholder, it's taxable, and that's CRA's starting position. Listen, we think that you had control over these gifts. You're the one giving them out. You gave this to yourself. Therefore, we didn't give it to as an employee. So in my case, right, the employee, there was actually a bunch of, everyone's name was in a hat, and their name got picked. Okay, you've got to remember that story, and it'd be great to have it on video to show CRA, hey, look at me, my number getting picked. You're not, but I tell you that because you got to set this out to CRA to explain that they weren't getting it qua shareholder, they were getting it as qua employee. Sorry, and qua is a lawyer term that sounds very fancy. It just means I got it because I'm an employee and not a shareholder. So 56 sub 2 is a section most people aren't aware of it, and it's basically just haha, I'm going to get you anyways. So, and I call it proportionate equal. So 56 sub 2 says if somebody else gets a payment by reason of you, I don't want it, but you can give it to this person next to me who I don't know. And therefore, it's not a taxable benefit to me. And hey, when are we leaving and going home? 56 sub 2, so they might not be related to you because you're just dating them, but 56 sub 2 can make that benefit to you taxable, right?
So
Why are they at the
Yeah, I think that this may, sorry, every time I talk, you look shocked. I think that this may answer some of the questions that we're having about spouses and their relationship with some of these gifts and things. So pay
So
attention,
spouses,
all those people who are asking about that, pay attention to this section here.
we'll come back to it, but 61A actually catches you as your spouse. 56 sub 2 catches them if you're just dating them, right? So this is the string of dates, as I call it. So, and I want to go back to a concept I call proportionate equality. And you see this in various things. For instance, benefit plans, health spending benefit plans for employers. I'm always setting up for employers, and it's like, does everyone have to get the same amount? And it's like, no. There's people who are, all businesses are basically a pyramid, right? There's very different important people. This is why we all get paid different amounts. And so you could get health spending benefits based on where you are in that pyramid. The people at the top might be entitled to get a higher health spending account amount, which is non-taxable, than the people at the bottom. It's proportionality of importance, salary. You want the CEO to have crucial health, because if he goes down, the entire company might go down, right? So you've got to watch the proportionate equality when it comes to gifts, because remember, the gift idea is, are you getting it as shareholder or employee? This is where I say equality doesn't apply. And I really like if you're giving away good gifts, make sure it's a round robin, names in a hat, where your shareholder influence cannot be exerted to make sure that you get the PS5. So, right, like, hey, I won the PS5. I didn't even see it on the gift table. Yeah, the awards were done in the hallway. So when it comes to spouses, I'm just gonna see if I can flip this really fast back to 61A. Remember, received or enjoyed by the taxpayer or by the person who's not deal at arm's length with the taxpayer. So not dealing at arm's length, the number one thing for that is they're related. They're related by marriage or blood, right? And you basically draw a circle around you, so your parents and your children, your brother, your sister are all related, and therefore deemed non-arm's length. Who you're married to is also deemed arm's length, and I think their plus ones in that circle is also non-arm's length. But I think your uncle is not related to you under this is where you're looking at, I think, 251 sub of the act for who's related. People can actually also act together, so they can be not related, but they can be acting at non-arm's length if they're trying to accomplish a common goal. So if somebody's at the hardy party, chances are they're with you, right? So if they're your spouse, then they are related to you, and if they get the cruise, then it's a taxable benefit to you as the employee, because they're only at the party and only have their name in the hat by reason of your employment. So what if you're dating them, like the people that I dated? I sound horrible when I say that. Have dated when I've gone to parties with them, which is a bad idea. Never take dates to parties.
Let's keep going. We have, I think, a few slides left.
So
7 minutes and lots of questions. So
56 sub 2 catches your date, right? If they get the prize, they're there because of you. They're getting it basically. It would be a benefit that would go to you, but it's going to them. You can be subject to tax under 56 sub 2. And remember, the only reason why they're at the party, right, is because of you. So again, indirect payments, this is where I'm just going on talking more about it. It's about the concurrence or participation by the taxpayer in conferring the benefit need not be active, meaning I don't want the gift, give it to this person who's just a stranger to me. No, it's you doing that and saying, I'm not taking this gift, and this gift goes to them. It doesn't have to be active, it's inactive, and you're still caught by, it's a taxable benefit to you under 56 sub 2. Documenting your spread of holiday cheer, right? Record keeping. So 230 sub 1 is your general requirement to keep books and records. 2 sub 3 4. So, and this is where I said before, but the most important thing in every audit I'm in is gift inventory control. You've got to know first who's attending the party, right? Because you've got to figure out the cost per person. If CRA go off CRA attended, then you've got to figure out that $150 limit. 2, if you're giving away prizes and they're not incidental and there could be over $500, then you've got to actually figure out who got it so that you include it on their T4. So, and remember, the CRA audit starts off with saying, if you didn't T4 them, we're actually going to give you no deduction. And I've seen these fights, and I always say it because maybe CRA is wrong, but tell that to the auditor, right? Oh, I don't care. This is my position. Go fight to objection. So then you're hiring someone like me to get in, and then it's a fight. And what if objection says no? Then you're in the tax court. So just keep a list. This is why while hardy parties are supposed to be fun, and it's a really boring thing, this is what CRA does. Let's make the parties unfun. So HST and employee benefits. Remember, if you're giving something to them, you are deemed to have made a supply. Like, I know that it's a gift, but you're actually deemed to have sold them that. And you've got to figure out the HST on what you have sold to them. So it's an administrative concession that it's not taxable to them, but it doesn't mean there's no implications to you. So for the income tax purposes, you'd be deducting the gift because you're giving to them by reason of, it's a business deduction, right? You make your employees happy, they keep working for you. But what about the HST that on the gifts? You've actually got to figure out the HST on that, and you've actually got to report that HST because you're deemed to have collected it from your employees, and you've got to pay that to the CRA. And I think it's the February year-end filing, or the February filing, or it occurs, I think, under administrative concession in February. But I just wanted to raise that everyone just thinks HST is nothing. It's like, well, actually, whenever, and this is not just gifts, this is any taxable benefits to your employee, you've got to figure out if there's an HST consequence to you. Should you be reporting the deemed HST collected on the fair market value of that gift or property? So again, and remember, the fair market value is not necessarily what you paid for it. All right, I think that's it. I think I did it under an hour.
You did, and I honestly think this is the first time that you've ever done that. So good for you, James. Awesome. So that was a ton of information, and I do think actually that several of the questions that have been asked, although I've been trying to get to as many as possible, the principle that is being asked for this question has actually been answered. It is in the context of the deck itself, or in the rules that James has talked about. But you guys are asking really specific questions. Well, what about this kind of thing? And what about that kind of thing? And I think that overall we've touched on all of the principles. And now part of your job may now be to kind of go back and say, okay, from a pragmatic standpoint, do these apply? Go ahead, James.
There is one question that's actually very interesting, and I hadn't thought of this, is on the people attended, is employees attending or everyone that attends? And to me, I actually don't know the answer to this. To me, it makes sense on everyone that attends. So that's a very good question. I'll actually email me and I'll look into that. But I am actually in my mind's now racing. It's like, oh, if I was CRA, I would say just the employees but I want to say it's everybody that attends. So I'm going to look into that. That's a very good question.
Yeah, so there are a few of those, like Lynn was asking, for example, what about, your client that invites you to their party? Are you included in the per people price, but then your client can't tax you, right?
This is
so
where, so there's the per person 150 is the benefits that go to the employees. So if you're just being invited, you're not an employee, you're not taxable by 61A, right? Hey, you're a great client, come to our party. So there's no risk of you having a taxable benefit. Although CRA, there is a release out there where it was I call it roll down gifts, where you send it a business, I want to thank you, I'm going to give you, say, Electrico a free cruise. And then Electrico says they got this free cruise, and Electrico is a corporation. The owner's like, I'm not touching this. So he says, okay, big raffle, employee, who wants the cruise? Because that cruise came from Electrico and not me, Jim, the electrician, to my employees, is it taxable or not? I'd say it's not taxable in the Income Tax Act. CRA started auditing saying it is taxable because it was meant to go to Electrico and not to Joe Worker. And so because Joe or Jane Worker got it, their employer gave up that cruise. I'm like, okay, I don't think corporations can actually go on cruises. We'll throw the minute books on the cruise ship. Right. Enjoy the minute books. The minute books, make sure that you put lotion on them. Don't let them get wet. So I say that jokingly because I saw this and I was like, yeah, that's a stupid policy. But they started auditing on this because they were looking at these big gifts that roll down through suppliers to to basically people that buy from them to keep buying from us, keep buying from us. Here's some really good gifts. So, because Joe or Jane electrician would go into Electrico and buy all their stuff from them, stuff like switches, because they can do that. They're on a job. I'm just going to go to Electrico and get it. And then I really love Electrico because they put me on that nice cruise. So to answer your question, I don't think you're just saying it's a client, you're coming in. I say it's not taxable. So you're not caught by 61A. So the $150 per person, I think it's per person who's at the party. Like you got a party for 3,000. If 1,500 of those are our clients and 1,500 employees, it's not fair to the employees that they suddenly have to pay a taxable benefit for everyone else, right? So that's why I say I sit back and I say the ultimate theory is always, what is the economic benefit to the employee? Because if they're better off, they should pay tax on it. But again, if they're at a party where half the people are clients, they probably have to be on good behavior and can't hit the shots. So I would actually say that arguably the value of the party's worth less because,
right.
You know, there's videos of me at another Thompson party where me and the managing partner were doing air guitar.
You're instantly devaluing the party. And
we were instantly on the dance floor and it was only us. And I was like, that was the best party I've ever been to.
That's awesome. So we are at risk of going over if we try to get to all these questions. Please forgive me, guys, for not being able to get to them all. Again, by principle, I think we've nailed a bunch of them, although some of the questions asked actually go back to kind of employee reimbursement and some other elements there, which is not what we touched on today. But yay for you and boo for James's inbox. I just shared his email address with all of you in chat. So feel free to reach out with any questions that you might have. We will, of course, keep you guys up to date in case we have any more of these sessions coming up. I also sent out the links for James's awesome LinkedIn group, Canadian Taxation Professionals, Sage's group, Canadian Sage Advocates. We would love to connect with you further and maybe get some discussions going in some of these groups around some of the questions that you may have, and James could provide some answers there as well. So that's another way that you could reach out. Yeah, go ahead.
And I'd say I urge everyone, if there's, I talk about everything, and if there's topics you want to talk about, reach out to Sage and say, listen, we'd really like to see a seminar on this. They really want to hear from you. So. For sure. Together we all get to listen to me. That just
Carla,
sounds so bad.
Yeah, Carla, if you could maybe put in, I think it's SAN Canada, if I've got that right, SAN Canada at sage.ca, and we would love to hear, or sage.com, sorry, oh gosh, and we would love to hear from you as well. So I believe, Carla, is that it? Am I hearing you there?
Yeah, that's correct.
Okay, awesome. So I will send that out if you do have any feedback or anything like that. And of course, you will be getting a questionnaire from today's session as well. So we would love to hear from you. And look, James is throwing it in my face, this beautiful water bottle again. Thank you all so much for attending. Happy holidays. We hope to see you in the new year. Thanks, everybody. Take care.